Hello everyone, my name is Eric. Welcome to the Savwire channel, and today we're going to be talking about gold prices and predictions based on the 18.6-year economic cycle, and in general looking at cycles in gold. A lot of data here. Let's jump into a chart right now, but here are some of the things we're going to be looking at. Basically Fibonacci extensions. We see a pattern there on the previous two cycles. A bars pattern based on the previous cycle to predict where we're going to go to in price action. The crisis year dips and continuations. I'm going to show you. There's also a pattern where it can retrace to, so we can figure out from where we can short target price levels, and then the current range and possible breakout and targets. So where to potentially buy if it dips down, and targets to sell, and then buy back. Let's get into that and look at the charts. So here I mapped out the previous 18.6-year real estate cycles after World War II. So basically more or less starting in 1955 to 1975. But we're pretty much looking at these three. 1, 2, 3. We're currently in this one. We're supposed to peak out somewhere around 2027. Once again, going back to, let's see. Once again, going back to this chart. So we have a mid-cycle slowdown, peak. More or less, these are the dates that we start at. Mid-cycle dips. Most recent one was 2020, and then the peak, so 2027, more or less. Then probably restart 2030. Copyright Ascendant Strategy and Investments, or this might have been from Property Share Market Economics. So full credit to them. They mostly are the ones writing about this economic cycle. But anyways, going back to the chart. So I was taking a look at the cycles and trying to measure the Fibonacci extensions, which, let's take a look at some of them. So peak to peak. So from this bottom here, back in the 70s to that top in 1975, which also marked the end of a cycle. And we can even look in here, the crisis. We have to keep in mind that gold is usually a hedge when the economy is doing bad, but I'm not going to get too into that. And I'm also not going to get too into the history, because we got to remember around here in the 60s, 70s, we were dealing with changing the gold standard and that kind of stuff. So that might have affected the price action differently. But when we look at the Fibonacci extensions, it's pretty consistent from this cycle to the next cycle. And it looks like the current cycle is also going to play it out the same. But yeah, let me get into the Fib cycle. So Fib extensions, previous two cycles. So the 0.618 is the resistance, and then flips to support. So here in the 70s, 80s, we see that the Fibonacci extension, the trend-based Fib extension, which is basically the bottom to the high to the next bottom, to kind of predict where the next levels could be. We see that the 0.618 here was resistance. It broke through here. And then the 1 was a target going back to the 618, which flipped from resistance into support. And then from there we went up. That's what happened here in this cycle. And then I'm going to show that it repeated in the next cycles. Let's just look at the charts in here to make it easy. So here we see what I just showed you. Basically this 1 fib going back to the 0.618 as support. And let's look at the previous cycle where with gold, which actually seemed to be much longer, but just from taking the local low to the local high and then the next low of that big move, we see that it also goes up to the 0.618 as resistance, and then it hits the 1 right on the 1 fib, and then it goes back to the 618 for support, and then blasts off from there. And the reason you want to look at that is because basically last time it happened was during the crisis year, which was 2008. That's pretty much when we started having the financial crisis. Well, I mean, that's where it peaked. Take note that a few years before it started to run. And if you read Khalil Patel's book, Property Share Market Economics, or study Phil Anderson's work, they talk about how gold, it starts to run before the crisis year, pretty much a few years before the predicted crisis. It starts to run. Here we see that it was a resistance level here. It was trying to break through the resistance level, which coincidentally was the 2 fib, which is a good target actually. Not on this chart. We see that it went up to almost the 5. That's another story, but 2 we'll see later on is a good target. 1 resistance back to 618 to the 2. And here we see that the 2 was a good held strong as resistance throughout the years. 1993, 1996, we went up again. And this time of the cycle, let's see, trying to get back to, but so when it broke through that resistance, you could see this level here. I can just mark it just for it to be more clear, and say right around there. So when it broke through that resistance, we see that it went up to the 618. When it finally broke through the 618, that can be considered like the final resistance. It went to the 1 around the crisis year, and then it went back down. We're currently at a similar Fibonacci level. Let's take a look at. So from this low to this high, once again we're at the 0.618, and it's going to, I'm predicting that it's going to go up to the 1 like it did before. Let's turn on the pretty much around the cycle peak, which is going to be 2027, 2026, 2027. Based on the fibs, it should go up to the 1 Fibonacci, so around $2,700. And then shortly after, full crisis is going to hit, people are going to start selling everything, including gold. So gold is going to take a hit, most likely. Go back to the 0.618, so around $2,000, $2,100, and then gold is a hedge in bad economic times, safe haven. So it's going to go up into the predicted cycle bottom, which is going to be 2030, and these are the cycles based on property values. So property values are probably going to bottom out around 2030. So gold is going to peak around then, and then based on previous price action, it'll go down to the 1. I'm predicting to the 1 Fibonacci again. If we look at the previous cycle, this high to low, around the 2008 cycle. So 0.618 was resistance a couple of years before the crisis year. So let's say 2006. And that's kind of where we're at right now. We're a few years before the predicted crisis year 2024. We're back at the 0.618 as resistance. So that's, you could say that's history repeating itself, and then going to the 1 and then bouncing back maybe a year or not even a full year after. It depends. It depends on how much it's gonna copy the previous cycle. It's never like exact, but I mean, we could say, you know, in 2028, maybe a year later or 2 years later, maybe a few months later, it can go back to the 0.618. So that's just looking at the past to predict the future. And from the 0.618, it'll go up to the 2, as it did in the last cycle, and then, you know, go down for a few years. So 2016, from the end of this cycle, which was about 2010, 2011, somewhere around there, 2011. So the next, so the dip that we can expect, the next local low on gold is going to be around 2035, 2034, 2035, somewhere around there. Obviously, the closer you get to that date, you'll probably have more data to work with, but just looking at it now, that's kind of my extrapolation. So, I mean, yeah, right now, that's my prediction. You know, just we're on a monthly chart, so really a long-term prediction. Once we break out of this 0.618, you know, it's winding up resistance, 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 and it looks like it should break through pretty soon, just based on previous price action, based on history. We can zoom in closer to see price level buy targets. Let's see. So there's a lot of data. I'm going to turn this off because it can get confusing. So this is just kind of the range we've been trading in. And then just looking at fib retracements. This fib retracement is from this low to this high. If it goes back to the 0.5, that would be, I would say that's a good buy level. I made some buy levels here. It could go down to the 1.25 retracement, which would also be kind of like hitting these lows. But personally, I think I'm going to set my buy around here, around the 0.5, because gold, it likes to go back to the 0.5 fib when you run Fibonacci retracements. There looks to be a good level of confluence around there. Obviously, it could just break through and go down lower. It might not even hit that 0.5. It looks like it's going into a flag right here. So it might just break through here and break out pretty soon. But if you would want to catch a good retracement, my buy is going to be around 1983, somewhere around there. We could even do a, let's see, we can do a trend base fib extension. So let's do from here to here to here, and that's gives confluence on this buy level. If it would dip down, unless you count that as the dip, it might have already dipped down to there. You know, another buy could be here. You could set a buy level at the 1, 1879, and the 1.618 and the 2 are kind of close to those other buy levels that I set, which coincide with other fib retracements. which I'm not going to get into because it's going to get confusing. But basically, if it's going to retrace, that's going to be my buy level, somewhere around there. You know, you could put a stop loss right there if you wanted to. So 3% stop loss. I can even just draw that in, just to make it more clear. So yeah, below the next low, and then obviously the target is going to be the 1 Fibonacci, a little bit below, so 34%. Obviously, it's going to take a while because it's probably going to hit around the cycle peak of the real estate cycle. So around 2026, 2027. So I mean, we're 2 years out to that, what, 34% gain. Unless something happens like in the 70s where it just goes way up. Well, in the previous 2 cycles, it did hit the 1 and went back to the 0.618. So that's what I'm expecting. And when I go back to this sheet, I was talking about how you could even short it from that 1 Fibonacci to back to the 0.618 fib. So you could put in a short position around this fib, stop loss to be determined. But yeah, you could go back to the 0.618. Let me turn off this fib extension, because it's going to get confusing. Let me turn off the buys, and just looking at the fib to fib, you know, you're going to have another potentially 20%, 22% short target, which that one's going to be pretty quick based on previous data, you know, even a few months. So that, you know, that may be a better trade if you don't want to tie up your money for the next couple of years, 2024 to 2026, 2 or 3 years. I mean, I'm not going to go back and look at the old data, but if you look at the previous cycles, this was typically a quick drop. Typically drops are a bit quicker. So that's a short idea, and then from there you can buy back at the 0.618 fib, because like I said, it's resistance that's going to flip to support, and then take off. And then looking at the, you know, you could take a long here again. So, you know, so just to make this simple and visual, I'm going to draw in another long position here. Stop loss to be determined once we get closer to those dates. And yeah, I mean this long, which is gonna be, it's gonna, you know, also be a longer play, you know, from 2030. What was I saying? Yeah, whenever it hits back here to the end of the next cycle, because that's how it usually works. So you go from the crisis, shortly after the crisis here, it's going to hit that 0.618 as support, and then it's going to go up into the end of the cycle. It's done that in the previous cycles, as I've shown earlier in the video, and that's going to be, you know, you could say 100% gain. If it repeated what it did in the 70s, which I don't think it would, just because I think that was just more pertinent to that cycle. You know, we had that stuff going on with the gold standard, and I guess less things to invest in, so maybe that's why it went up to the forge of the fib extension, as you know, I'll show you in this chart. You know, low to high to low fib extension. Like I said, I'm going to repeat it again. 0.618 resistance to the 1, flip to support. 0.618 flip to support. In the previous cycle, it only went up to the 2 Fibonacci extension, and then it went down to the 1, which that's what I wrote out here, the fib retrace, even back in the 80s. It didn't hit it all the way, but it almost went down there. But in this bull cycle, it just went ballistic. It went to the 4 fib and almost to the 5. And I guess we'll see where it goes to. It might go all the way up there. This 18.6-year real estate cycle is supposed to be a lot bigger than the 2008 cycle. This bull market is supposed to be a lot bigger than the last one. We have the 100-year cycle, so 1929, 2029. So we might just get a lot more frenzy. So it could go up there, and on the flip side, it could go. It could not hit the 2. It could maybe only go to the 1.618. But there's a lot more things to invest in these days. So people just might not be that interested in gold, but we're just looking at predictions based on the previous cycle. It might go up to the 2. You could say that since 2 cycles ago it went up almost to the 5 or to the 4. Last cycle it went up to the 2. This cycle it might only go up to the 1.618. So keep that in mind. So going back to this potential long, which probably it's going to come in, a good buy-in is going to be around 2027 at the 0.618 if history repeats itself. 2027 to 2030, 2031 based on previous history, and then you could buy in at 2080, somewhere around there, 2090, 2100, $2,100, and then sell at anywhere from 3,700 to 4,300 plus. It's something that you're gonna have to keep an eye on, and I'm sure there's other experts that can put in their 2 cents on when we're nearing the top. But you could set a take profit here, 77%. Take profit here. I think a 2 fib would be a good one. And that's 100% gain in 3 years. And obviously gold is, you can consider it a much safer investment than stocks and other things. So if you're looking for a safe play, this could be a safe play if you're willing to wait a couple of years, 3 years for 100% gain. This is just some things that I've been looking at. These are my personal predictions that I've made and something that I'm going to be looking at. But right now, we're at that 0.618, which has previously in the past been a resistance point, and we're looking to break it pretty soon in the next couple of months. Who knows when, but like I said, if you want to buy in, a good buy-in point around 1980, 1986, 1983. One thing that I forgot to show was the bars pattern. I copied this from the previous bull run, and we see that it's kind of similar. It doesn't, it kind of rhymes. It doesn't. It's not a one-to-one copy, but we see that it's slowly rolled over faster, and it's going up, and that's kind of the overlay I made up into here. So take that as you wish. Take it with a grain of salt, not investment advice, etc., etc. Just some ideas. Thank you for tuning in to Savwire, and have a good day. Let's see. It's just a prediction. So thank you for tuning in. Have a good day, and take care.